Short exercise 10-9, Journalize disposal of plant asset. So we have Beta Communication purchased equipment on January 1st, 2025 for $36,000. Suppose Beta Communication sold the equipment for $26,000 on December 31st, 2027. Accumulated depreciation as of December 31st, 2027 was $16,000. Journalize the sale of the equipment, assuming straight-line depreciation was used. So when we dispose of an asset, there are 4 steps we have to go through. Now, disposing means getting rid of a plant asset. That could be throwing it out, discarding it, could be selling it, or exchanging the plant asset for another plant asset. So the first step we need to do is bring the depreciation up to date. Once that is done, then you have to remove the old disposed of asset and the associated accumulated depreciation from the books. So we get rid of the asset from the books and we get rid of the accumulated depreciation from the books. Then we're going to record any cash received or paid and the disposal of the asset, and determine whether there was a gain or loss by comparing the cash received and the market value of any other assets received to the book value of the disposed asset. So basically you're just going to compare what you got versus what you gave up to determine if there was a gain or loss. So the first step, bring depreciation up to date. Fortunately, in this problem, that has already been done for us. So how do we know that? It's because the company says it sold the equipment for $26,000 on December 31st, 2027. Accumulated depreciation on that same day was $16,000. So that first step, which is bring depreciation up to date, has already been done. So let's work for us. So first we're going to calculate any gain or loss on the disposal of the equipment. So the way we do that is we compare what we received versus what we gave up. So the market value of the assets received said we sold the equipment for $26,000. So I'm going to go ahead and put that right here for the fair value. So what did we give up? We gave up the asset here, the equipment, which cost us $36,000. So we're going to input that here, $36,000. And less the accumulated depreciation, which was given to us here for the $16,000. So then we have the book value of the asset we disposed of, which is a guess again. So we have that cost less the accumulated depreciation, and that's going to be $20,000 there. So we need to get rid of this off of our books here, which is now worth $20,000, which is a bit of a wreck on the books here, from $36,000 to $20,000 here. So let's take a look at that gain or loss. So is the fair value more than the book value? It appears yes, since we received $26,000 in cash, while it's worth $20,000 left over. So that gain here is going to be the $26,000 minus this $20,000. So that is going to be a total of $6,000 gain. And again, why is it a gain? It's because we received more than we gave up. So let's go ahead and check our answer. Well done. Okay. And now we're moving on to the second portion of the problem. Now we need to journalize the sale of the equipment, record the debits first, then credits, select the explanation on the last line of the journal entry table. So this is step 2 then. We need to remove the old disposed of asset and the associated accumulated depreciation from the books. So because I'm visual, I like to do T accounts, and then it becomes obvious how we get rid of this. So you can do these in Excel if you'd like, or scratch paper. So the cost right here of our equipment is that $36,000 is represented here on the plus side, since it is an asset, the left side debit. And then with the accumulated depreciation, that $16,000 is on the right side increase with a credit. So which one of these will need to be debited? So equipment, since it is increased on the left side with a debit, it will need to be credited. However, with accumulated depreciation, to remove the 16,000, we'll need to debit it here on the left to remove that 16,000. So first off, since we are recording the sale here, we're going to need cash since we got $26,000. So that will be a debit to cash to increase our cash by 26,000. And then, as you'll recall, with our accumulated depreciation, that is going to get debited out as well in order to get rid of it. So that's the accumulated depreciation equipment. Make sure you don't use the expense account. And so we'll have that 16,000 there. And then we're getting rid of equipment. And again, how do we get rid of an asset? It will be with a credit, because again, the balance sits normally on the debit side, the left side. So we're getting rid of our $36,000 equipment. And as you can see here, the transaction does not yet balance. There's one more thing we're missing. We're missing the gain or loss. And we did calculate it here in the first step. It was a $6,000 gain. So we'll go ahead and input gain on disposal. So another reason you know this is a gain is because gains, like revenues, they're on the credit side. So if this was a loss, it would be a debit. So we'll go ahead and input $6,000 as a credit here on the right. And then our explanation at the end is going to be sold equipment for cash. And then let's go ahead and check our answer now that the debits equal the credits. Good job.